This is what most investors see when they look at a chart of U.S. stocks. This is what I see. Stocks are just 5% from an all-time high and a ball spiking end zone dance. The sentiment has turned bullish, but making it across that goal line won't be a walk in the park. Just like in football, the last few yards in the red zone can be the toughest. On Thursday last week, we saw how fragile that sentiment is. Every bull market has its Achilles heel, and this one is no different. Welcome to the Money Runner. I'm David Nelson. Every time 10-year Treasury yields start to approach 4%, investors get nervous and start taking down exposure. That's exactly what we saw Thursday last week. I didn't notice it right away, and maybe you didn't either, but the computers did, one by one, kicking off sell programs, wiping out the day's gains. Look at 30-minute bar charts for the S&P 500 up against 10-year yields. Once there's even a hint that 10-year rates are heading above 4%, the sell programs kick in. The reversal was notable in that Thursday was a risk-on day. Traders and investors were celebrating another breakout performance from Meta, now up 175% year-to-date. This time, it wasn't comments from a rogue Fed official or even a hot economic release that ended the party. No. This time, the trigger was pulled half a world away. The Bank of Japan loosened its policy of managing the yield of 10-year Japanese government bonds. The BOJ already owns more than 50% of all outstanding JGBs. That shift likely caught world debt markets off guard, forcing fixed income and equity traders to adjust. I think this setup hurt hedge funds on Friday. On Thursday, hedge fund managers pressed their short book heading into the close, looking to cash in on the heels of what market technicians call an outside day. Traders added to their shorts, confident in a Friday payoff. Okay, let's discuss what is an outside day. Outside days are often interpreted as a sign of increased volatility and a possible reversal in the prevailing trend. The current day's price bar has a higher high and lower low than the prior bar. The open and close of the second day fall outside the open and or close of the first day. Unfortunately for the bears, any hope of cashing in those chips on Friday melted away once the inflation numbers started rolling in. The economic releases were in line or better than expected, showing once again what stocks had sniffed out months ago. The Fed's favorite indicator, PCE Core Index, came in as expected and decidedly on a downward trend. The Employment Cost Index came in a full 0.1% better than advertised and now sits at 4.5% year on year. Inflation continues to head south, suggesting the Fed is done, or at worst, very close to peak Fed funds. We can debate higher for longer or even the wisdom of a Fed cut. But what isn't up for debate is that the U.S. economy has bigger concerns than a hawkish Federal Reserve. The Fed has done their job. It's time for government to do theirs. End blank check politics designed to buy votes while catering to the will of lobbyists and big donors. The policy shift from the Bank of Japan caught most of the street off guard. We have a myopic focus on inflation, the Fed, and the Magnificent Seven stocks that have driven much of the market performance this year. We forget that forces beyond our borders can have an outsized effect on markets here. Are there risks out there? You bet. But there are even more opportunities. We're not in crisis mode anymore. The bear market low was last October, a view that is rapidly becoming consensus. That shift in sentiment provides needed support for markets. The mountain of cash and cash equivalents sitting on the sidelines is fuel, ready to be deployed. We'll have corrections along the way, but now those corrections will be viewed as an opportunity rather than a liability. On deck this week, we have two more of the Magnificent Seven stocks reporting. Apple and Amazon report Thursday evening, setting up for a monster trading day on Friday. Why? Not only will we have two very important earnings reports driving market action, but we also get July jobs numbers that will in part influence the Fed's next rate decision. Apple is clearly the toughest to defend, given that just about every line item on the income statement will be down year on year. Take your pick. Revenue, net income, free cash flow, all lower than this time last year. The only line item that will likely improve is earnings per share, as Tim Cook continues to buy back stock. I keep repeating this ad nauseum, but a stock buyback does nothing for revenue, nothing for net income. It only gooses earnings per share because the share count goes down. We learned long ago that valuation is not the only thing that drives equity prices. If that were true, Apple would be trading at 100 instead of waltzing into this report close to 200. The mystique that surrounds Apple has helped support a market cap rapidly approaching $3 trillion. At a massive installed base of users and a 30% cut of every purchase in the App Store, it becomes hard to argue with this success. If the market has an Achilles heel, the App Store and that 30% take is Apple's. Regulatory risk is the biggest challenge for CEO Tim Cook, along with every shareholder. Amazon is similar in a lot of ways. Another company where investors have chosen to look beyond valuation when making a decision. Bulls on Amazon will be looking to strong commentary on AWS growth in the second half this year, as well as improved margins at retail. I expect the obligatory commentary on generative AI and how they intend to harness its power. At a minimum, we should expect a significant ramp up in AWS to be mentioned on the call. At 50 times 2023 earnings, there isn't much in the way of valuation support. Of course, at Amazon, there never was. If you liked the pod today, you know the drill. Hit subscribe, and if you get a chance, head on over to our site, themoneyrunner.us. Lots of extras, including the ability to record a question and be on our next podcast. And don't forget comments, good and bad. I promise I can take it. I get back to everyone who takes the time. Thanks for joining. I'm David Nelson.